Hello, everyone. Welcome to today's webinar with me, Fawad Razaqzada, market analyst with Think Markets. And in the room is my colleague Victor, who is back from his long break, and he's ready to rock and roll in his own words. How are you, Victor?
Yeah, very good, very well rested, and very focused on the markets already.
It's been a very interesting start to the year, hasn't it, Victor, with technology stocks slumping, yields rising.
Yeah.
What's the main driver behind this?
So, so the sell-off was primarily driven, I think, by the increased hawkishness of the Fed during the release of the uh, mi- minutes, the Fed meeting minutes last week, which basically signaled that the Fed is even considering to start reducing its balance sheet size,
Wow, okay.
something that the markets haven't priced in and never even thought about it from the post-meeting announcement that the Fed released at the time of the latest FOMC meeting. So this was something that the market really hasn't digested, and as a result, we saw this very sharp sell-off in risk assets at the end of last week. That basically plateaued yesterday.
Yeah, it did, didn't it?
So whether we're going to be able to return to higher levels remains to be seen. But yeah, we'll talk about that more when we analyze the charts. No?
Indeed, yeah. Before we get to the charts, let me just remind you that these webinars are for general information only and are not intended to provide, excuse me, they're not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think markets shall not be responsible for any loss that you incur, either directly or indirectly arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So, I forgot that this is our first official live session for this year. So for those of you who have joined us live, I wish you a happy new year and hope that you've had a wonderful break, and wish you all the best in the upcoming months. The markets have started really volatile, with equity indices rising initially at the start of the year and then slumping, as Victor just mentioned, on raised concerns about tightening from the Fed and other major central banks. The dollar likewise has been all over the place, and we've seen bond yields rise.
The dollar has been rapidly moving nowhere.
Rapidly moving nowhere. Yeah. What do they call that? Static volatility. That's the term, right?
Well, yeah, it's been quite a frustrating
Yeah.
few weeks for
Yeah.
FX traders. And guys, you shouldn't be surprised by this. The beginning of the year is usually when we tend to digest what's
Yeah.
coming.
Yeah.
So yeah, just give it a little bit of time before you
Indeed.
make a directional decision, especially in the tight ranges, as we
Yeah.
shall see now that Fawad is taking over with his charts.
I will do in a minute, but just a quick reminder for those of you who are new to this webinar, or those of you who are watching a recording of this webinar for the first time. This webinar is happening every Tuesday, 11:30 London time. We cover technical analysis and fundamental analysis on major currency pairs, gold indices, and now cryptos as well. We always have a Q&A session at the end of the webinar, but we encourage you, for those of you who are live in this webinar, to ask us questions during the webinar as well. And we will get to your questions as and when they come. So moving on to the charts then, and before we show you the charts, just a quick reminder of the things that we've got coming up this week. Today is Tuesday. We have the Fed Chair Powell testimony and a couple of speeches by Fed's members. US CPI is the main data highlight for the week. That's happening on Wednesday. We have more inflation data in terms of PPI on Thursday, when we also have the jobless claims. On Friday, it's a busier day for the data. We have for the economic calendar. We have some UK macro pointers in the morning, as well as German GDP. Then from the US, we have retail sales, industrial production, and more importantly, I think the University of Michigan's consumer and inflation expectations index, because obviously all the talk has been on inflation, and inflation has caused everything to move in all sorts of directions, and it's most obvious in the government bonds market. So if you look at the 10-year US yields, we have briefly peaked above, I should say, the high from last year. We've been banging on about this for several months, haven't we, Victor?
Yeah.
Yields are going to break out eventually, and although it, they did take their sweet time.
Well, it's not like they have broken out above the previous high, but they tested it. So we did expect that to happen. Now there comes a very interesting question. Now, if the yields have tested last year's peak, why isn't the dollar doing so?
This is because, in my view, it's not just the US yields rising. If you look at, obviously we're talking about the relative basis here. German yields are still in negative, but on a relative basis, they have risen at a faster pace in the last few days. And I wonder whether this is to do with the fact that Europe is expected to peak in terms of Omicron virus cases, whereas in the US, things have just started to go down south in terms of infections and so on. So the markets are probably expecting some moderate weakness or relative weakness in US economy to come in the months ahead. Whereas Europe is probably in a better position to recover from the pandemic, from this wave of the pandemic, I should say, when things finally die down, and I hope that that will be soon, because we've simply had enough of it, right? We don't want another wave after this one. But I'm sure we will get another one, unfortunately. But so that's the I think the market's interpretations of the events, which is why we're seeing German yields rise. And also, if you look at the UK yields are testing their highs from last year. They haven't broken out yet, but they too have risen sharply in the last few weeks. And as Victor mentioned, it's all to do with inflation and central bank tightening expectations. It's not just in the US, but everywhere across the major developed economies.
Yeah, pretty much. So while the yields in the US have been hitting new highs over recent weeks, the dollar has been consolidating, and it keeps consolidating.
This has been a very lengthy consolidation, hasn't it, Victor?
It's been a month and a half, almost. Even more than that. We peaked out at the end of November. So about a month and a half of consolidation, something that is usually followed by a trend move.
Indeed.
So which side will that be on? Don't ask me.
The trend is still bullish, all told. The 200-day moving average is rising. We're above it. So the long-term trend is bullish, objectively. The shorter-term trend is obviously directionless at the moment, but we are seeing higher highs and higher lows. So I think we both agree that the Fed remains head and shoulders above the other major central banks, like the Bank of Japan, the European Central Bank, and the Swiss National Bank.
Actually, the Japanese yen is probably a good example
Yeah.
why the dollar is the dollar is stronger. As well, the risk episode last week did give the Japanese yen a boost, but it's at this point in time, it has basically broken out of those long-term levels on the weeklies and on the monthly charts. It's looking quite bullish. So yeah, it would take a major risk reversal,
indeed,
for this pair to fall back, to reverse this move. As mentioned, we had multiple tests of the 1450 area. We broke out. We tested 116, if I'm not mistaken. And we briefly
eased back a little bit.
We briefly were above it, but this trend has not reversed yet. I don't see it reversing for any fundamental reasons either, meaning that there is no real reason for the dollar not to continue rising against the yen. The only thing that can deter that is probably a major risk asset sell-off.
Even in that case, we have seen episodes of the Japanese yen not really acting as a haven currency during the past stock market turmoils. Certainly not to the extent that it used to react. I wonder why that is. Is it because people really don't believe in it as being a haven currency anymore? I don't know, but the most important point is that it is rising. The dollar yen is rising, and
I guess it has to do with the flows. To answer your question, the U.S. equity market is still seen by Japanese investors as a major point of investment, as a major asset class, and much more tastier than their own stock market, because while the Japanese technology giants exist, they are way too focused on the Japanese economy, and they do have their own software giants alternatives. However, they're nowhere near as globally focused as the US ones, and that is what really is driving this rally still. If we look at the US stock market, the outside of can you go to the Russell 2000?
Russell 2000. Yeah, sure.
You have it. You can add it. Oh yeah, you have it. Yeah.
Are we looking at a very long-term chart or?
Yeah.
Weekly here.
So basically, the Russell 2000 has spent the past
the past year.
The past year in nowhere territory. The whole rally in US stocks has been driven primarily by 4 or 5 companies, and those are Microsoft, Google, Apple, Facebook,
causing the Nasdaq to rise while the Russell consolidated.
So this is something to have in mind here. Like the revenues of these companies have risen dramatically during the pandemic, while the rest of the economy hasn't really benefited from this recovery that much. It's really something to have in mind
Yeah.
while the Fed starts to raise rates as we expected to. Like this morning, Jamie Dimon from JP Morgan, the CEO of JP Morgan,
Yeah.
has alluded to 4 rate hikes, and in his opinion, 4 rate hikes won't have a big impact on the economy.
Yeah.
I wonder, where does he get this from? Because as I see it, the Russell 2000 has been nowhere over the past year. So assuming rates rise, how are these companies going to perform better is beyond me.
Yeah. Yeah, it's difficult to say. The only exception being obviously financials, maybe because higher interest rates tend to be good for banks and other financial institutions that charge interest. Apart from that, I mean, higher interest rates usually point to a stronger economy anyway. So domestically
Well, yes,
focused,
basically,
yeah.
we need not forget that JP Morgan is CEO of a major bank. So higher rates are
There you go.
good for JP
Yeah,
Morgan. There you
yeah,
go.
yeah. So that answers our questions. Let's move on. Just before we move on from the Russell, I think it needs to clear this shaded blue area for it to turn bullish. This is still, in my view, a bullish consolidation. You know, if this fake out was a major reversal sign, well, it was a significant reversal, but there wasn't a lot of follow through to the downside, and we didn't break the 2100 level, which has been support consistently in the past year. So for as long as that level holds, there is still hope that this long-term bullish trend can resume. But we need to see some confirmation now, and a move above
Yeah.
the shaded region is what I'm looking for. For if we get there, it will also move us back above the positive territory for the year. This right here, this purple line, is the opening level for this year. So right now, the bias is certainly bearish because we opened positively, and then think of a yearly candle. It opened positive, it went higher, and then it reversed, turned red. So right now, the yearly candle is red, right? So because of that, we don't want to be exposed too much to the upside because the trend is bearish. But if and when this level is reclaimed, and we move above the 200-day moving average, then at that point, all of this deviation from below the yearly opening level can be thought of as a wick of the candle, of the yearly candle, right? And then once we get into this area, if we get there, then the ranges could expand to the upside, and you could think of like a hammer-like candle being formed on the year. So once we are in this area, that's when I think it will make more sense to be more aggressive on the longs than where we are at the moment, albeit we are very close to support. So that's why we're seeing some dip buying, opportunistic dip buying from investors after yesterday's sell-off. And it wasn't just the Russell that found dip buyers. The Nasdaq even managed to bounce once again off the long-term bullish trend line that has been in place since September of 2020, 2020 rather. And this trend line has provided support on multiple occasions. And once again, it trapped the sellers in that we broke below the previous lows. For a moment there, it looked quite bearish because we created a lower low, but then stepped in the dip buyers, causing the index to turn positive on the day. And now we are testing liquidity above the high of yesterday's candle. So yesterday's candle was a hammer-like candle, right? Which is usually a bullish looking formation from a technical point of view. The fact that it's happened at the long-term trend line makes it even more significant.
Reinforces it.
Yeah.
Well,
it is possible. Sorry, before we sorry to cut you off there, Victor. It is possible that we may go on to test the other side of this shorter term trend line that had been broken before reversing. And we could even head down to the blue shaded area, which is a more significant support zone in my view, because we have the 200-day moving average there converging with the point of origin of the previous breakout. The area around 15,000 is where I was expecting the market to bottom out. We didn't quite get there, but we might still in the days ahead. So it looks like the markets have reversed, but the bulls are not completely out of the woods just yet.
Yeah. So the major the major trend continues, which is once the market hits new all-time highs, it sells off, and once everyone thinks there is the breakout, it reverses and marks a new all-time high.
Yeah.
Let's see how long this can continue, but yeah, there is this is which the fifth test of this long-term trend line, or
it looks like that. I think so. Yeah. At least the fifth. One, two, three, four, five, sixth.
Sixth. All
Yeah.
right. Well, let's see if lucky number 7
yeah
shows up somewhere here.
This is quite common, isn't it? This fake breakout. I mean, if you look at, for example, these lows here, 1, 2, 3, we broke below, and then it was quickly rejected, went back above, tested it from upside, boom, it rallied. Then we had where was it? Here, the market was bouncing from this trend line, create a head and shoulders reversal here, or apparently head and shoulders, broke below, tested the trend line, reversed, and then we took off from there. Now we're seeing a very similar picture in that we formed this double bottom low, broke below, failed to hold below, and now we are moving higher again. But with things that might be a little bit different this time because of the rising yields. So let's see how yields play, because remember, yields also reversed yesterday, didn't it, from their highs. If you look at the US 10-year, for example, there was a inverted hammer candle at the previous year's high. So maybe yesterday's hammer candle that was formed on the Nasdaq, the corresponding hammer, may have been due to profit taking than actual, buying interest. So take this with a pinch of salt.
All right. Shall we move on to other indices? Or
yeah, I quite like the look of FTSE because unlike the Nasdaq and some of the other global indices, there are literally no technology stocks in the FTSE. Usually, that you wouldn't like an index that doesn't have a technology stock in it. But right now, I like the FTSE right now because right now the focus is on value stocks, those that tend to benefit when the economy is doing well, and also banks, which have been on the rise, right, because of higher interest rates. Now, unlike the US indices, the FTSE is in the positive territory for the year. We opened, or we closed the 2021 around this level here, this purple line, and we've started the new year above that. We've seen a couple of moves lower since, but we haven't gone back to below last year's closing level and stayed above this key resistance zone, which was then broken. So right now we are back above the 2021 high, which was hit on literally the last week of 2021. We are above that high, this green level, and it looks like the FTSE might be headed towards these targets, the 2020 high, 2019, and then the all-time high that was hit in 2018. So it's got some catching up to do with those targets, and I think for as long as the sentiment towards global indices don't turn negative, we could see an accelerated move towards some of those targets in the days ahead. Apart from these, from the fact that it's in the positive for the year, Notice the moving averages are rising, the 200-day moving averages, providing consistent support for the FTSE in the past. The 21-day exponential is rising and widening its gap between the 200-day, suggesting that the shorter term trend is gaining momentum, right? All indications suggest that the FTSE could be headed much higher from here. Do you have any particular index that you're interested in apart from the ones that we've covered so far?
Well, I think that it's worth having a look at the DAX.
DAX, okay.
Yeah. So it's another industrial heavy index, which is struggling at this point in time, considering the timing, the openness of the ECB to keep its policy at current levels for a long period of time. The DAX is not very convincing. What do you think is going on here from a technical perspective? I see we have a double top around 16,300. So yeah, so something's off here.
Right.
I don't like it. I mean, if I was an investor in German shares, I would be puzzled as to why is it trailing so much.
I think part of the reason is that the fact that we have seen some strength in Eurozone data of late. For example, inflation rose to 5% last week, or was it this week? 5% inflation may scare some of the ECB officials from remaining too aggressive in their current policy stance, which means that they might start to taper faster and potentially even look at raising interest rates to control runaway inflation. Energy crisis in Europe is another thing. It's going to hurt consumers' pockets. So there are a couple of fundamental reasons behind this move, but from a purely technical point of view, this double top might look scary, but the flip side is that we haven't broken down completely. We are still above the 200-day, testing the 21. And in fact, for a brief moment, we moved below this year's opening level, which was here, but we didn't stay below that. So this orange line as well, if you look at the weekly, this is the low from the previous week. So there was lots of stops presumably resting at that level below last week's low. Those levels were those stops were taken out, and now look at the weekly candle is flat. So it looks like the move down could have been a stop run on the longs, on the weaker longs, and the index held support in the shaded region, which is previously support and resistance. And so if we can hold above this area now, I think we may see an eventual move above this double top high, where undoubtedly there will be lots of stops from the bears resting. So I think the start of the year, everyone is not too keen to press ahead in with directional moves in their trades, and the fact that we've seen a accelerated downward move for the last 3 or 4 days means that we may see a trend reversal, and the index goes in the opposite direction for a few days now. So I wouldn't be surprised at all if the DAX now starts to climb higher and takes out the double top high. The main reason being is the ECB is still dovish, is still providing lots of liquidity, and there are hopes that this latest wave of coronavirus could be the last one, or the last major one before things go towards normal. Hopefully, that's the main hope. Obviously, the markets are rising on hope anyway. But with the vaccinations continuing around Europe, albeit with some resistance from some anti-vaxxers, hopefully, the strength of the virus is going to wane, and people can resume, somewhat normal life once again, and there will be pent-up demand for holidays and travel and so on to look forward to in the summer months, hopefully. So yeah, that's my view. Yeah.
Good. So shall we move on to some FX pairs? We spent
Sure. We briefly touched on indices.
Yeah.
We briefly touched on the dollar yen, didn't we, at the start of the webinar?
Yeah.
It looks like it's trying to bounce from the shaded gray blue area, which is support, previously resistance. If we go above the 2021 high, which is here, on a daily closing basis, then that would, in my view, trigger the bullish signals that some would-be longs are waiting for on this currency pair.
Right.
Yeah.
So shall we move on to the British pound? It's
sure.
It has tested some levels on the hourly chart and on the daily chart this morning.
Oof! Look at this. Yeah.
Yeah, we had a showing above 136, and we're back below now. So yeah, it seems like the bulls have finally tired, and well, let's not get ahead of ourselves.
Sure.
I mean, we are.
The day has just started.
Yeah, we are at key levels. And the first attempt, or yeah, you could say that it was the third attempt above 1/4 attempt above 136. Has yielded some results in the fact that stops above 136 got cleared.
Yeah.
However, do we manage to stay above that level, or are we reversing for a corrective move here after what is it, like 3 weeks of steady rise? Wow.
Yeah. So this could be interesting, isn't it? Insofar as the short-term trend is concerned, anyway. I am not too keen on the pound in either direction, to be honest. Especially against the US dollar, because the dollar is rising against most major currencies, or has been rising against most major currencies. The pound, obviously the Bank of England has started tightening, so there is some support, fundamental support for the pound. Perhaps looking at the pound against a weaker currency might make more sense. For example, the pound against the Japanese yen, or a pound against the Swiss franc, and that sort of those sort of currency crosses. But in terms of the hourly chart of the cable, we moved above 136, as Victor mentioned, gone back below. Let's see if it will go on to break down below this rising trend line before we see some accelerated move to the downside, or we just simply go back above 136 and consolidate there. To be honest, I'm not very sure which direction it will take, and a lot will depend, no doubt, on the outcome of the US CPI, which is due to be released tomorrow.
All right.
I quite like the pound yen, as just because we are talking about it right now. So let's quickly look at it. The pound yen, multiple times it tried to break down here at 150. It didn't. It held there. And then we saw one final attempt on 20th of December before it just took off without looking back. So the trend is clearly bullish. We have subsequently moved above 156, which was previously resistance. And I was very keen to see what happens on the retest of this level, from above. And so far we're holding, which is a positive sign, I suppose. So as things stand, it looks very likely, in my view, that the pound yen is going to clear the previous year's high at 158.20. Pound Swiss, another one,
A very
trending really
strong,
nicely.
yeah, very strong uptrend. It looks like the Swiss franc has definitely lost its luster after some comments a couple of weeks ago from the Swiss National Bank, which continues to be very unhappy with the strength of the Swiss franc, while at the same time it keeps very easy monetary policy. Keeps buying assets abroad with its newly printed Swiss francs.
Yeah. Speaking of which,
nothing can knock it down.
Speaking of Swiss franc, let me share with you EURUSD, the forgotten currency pair. I was talking about this currency pair with a couple of my colleagues the other day, and mentioned that it could be about to resume higher. And when we looked at it, it had just completed this bullish looking candle on the weekly around 104 area, 103.50. And since then, we've seen some further upside follow through. Now, what I want to see next is, can it stay above this black line, which is the low from May 2020, the post-pandemic low, or the immediate post-pandemic low.
Right.
If we go above that, I think it would signal a change in the trend and in investors' thinking. Perhaps people are becoming a little bit more concerned, or expectations about tightening of monetary policy in Eurozone is kind of rising with inflation going above 5% and so on. So above 104.90, call it 105. Yeah, above that level, I think we're bullish on a daily closing basis.
Right. Okay, shall we have a look at oil?
Sorry, I didn't catch that. You said oil?
Shall we have a look at oil? Yes.
Yeah.
Yes.
Okay. US?
Yeah, well, both oil benchmarks have been moving quite strongly in recent weeks, and quite strongly to the upside. Well, while Omicron has been taken over, oil doesn't seem to mind that in any way. Are we getting to the point where persistent underinvestment in new oil exploration is hitting the market?
Yeah, we could be. I think also if you look at a couple of OPEC countries, they have a struggle to raise output. The OPEC has been raising the target by 400,000 barrels per day of oil every month, right? But some countries, they have failed to meet that target.
Right.
So that I think you are quite right in that, and also there are also temporary production outages and so on that has been helping to fuel this rally in crude oil. But I think in addition to that, we have seen in the last few weeks, or certainly in the last couple of weeks, travel restrictions have eased. For example, a large number of countries in Europe had banned UK travelers because of the spread of Omicron variant here in the UK. But since around I think last week or the week before, the likes of Germany eased restrictions, and a few other countries as well. Although some, like France, still has controls on UK arrivals. So it looks like investors are pricing in further easing of travel restrictions around the world as booster vaccination programs roll out and gather momentum. So I think there's both the supply, the issue of supply you mentioned, but also I think demand has not been impacted as severely as had been expected by the initial drop in oil markets when news of Omicron first emerged. Although we haven't really cleared the previous highs, have we yet? Remember, Omicron variant came in around November time, I think it was. So we are still not quite testing those highs just yet. But 80 is a very important level, psychologically important level. And oil has struggled there in the past, in October and in November. Couldn't hold above that area. So it's possible that this current wave of the rally could peak around 80. So that's something I would keep an eye on, especially given that U.S. oil production looks like it's going to rise with oil rigs, climbing higher in every month consistently now, suggesting that in the future there will be more oil exploration and so on. But we need to see that reversal stick first, a confirmed reversal, before we turn bearish on oil, because currently the trend is clearly bullish.
Right. It keeps on. It keeps on rallying on very shallow dips ever since. The middle of December, and there is no. We should have the geopolitical preliminary discussion before a meeting between Putin and Biden. I don't see anything good coming out of this for the oil market. I mean, sorry, for oil consumers, to be honest. Both sides have dug into some red lines, and I just don't see them coming to any sort of a resolution anytime soon. So geopolitics is certainly pressuring the oil market.
Yeah, there were also supply problems in Kazakhstan. I think on a couple of days ago.
Something that has probably impacted the markets last Thursday, if I'm not mistaken.
Sure.
When prices rallied by $3 or something. Yeah. So while a resolution to that conflict has come in some way, the local government claims to have the situation under control. Whether it really does remains to be seen.
As we now approach 80 psychologically important resistance level, one thing to keep an eye on is China with their zero COVID policy. They are very quick to put cities in lockdowns, and they've already done one city, one of the major cities actually, with 5 million people in the Henan province. So that's something that could derail this rally with demand from China, the world's largest consumer of oil, I think, potentially weakening if the Omicron variant spreads in the country and we see lockdowns there. So that's something to keep an eye on. Let's move on to cryptocurrencies very briefly then, Victor. This version of our weekly webinar has been an extended one. We usually finish within half an hour, but because this is the first one for the year, we thought we should have an extended version so that we cover all grounds. And I saw a very interesting chart yesterday in cryptocurrencies, namely the Bitcoin chart, which was at the time when I was writing about it, it was falling quite sharply to that 40,000 psychologically important level. The reason why I thought that was a very important level is because not only is it, as I mentioned, a psychologically important level, but this level was previously support and resistance on several occasions in the past. And there was also a rising trend line that was coming into play around that zone, which made it all the more important from a purely technical point of view, which is probably why we saw which is why we saw a rebound of the lows, as you can see by the candle that was formed yesterday, which is a doji candle.
Yeah.
Yeah. So I think
doji or a doji or
a long-legged doji, right? Yeah. So this is possibly a bullish scenario. We just need to stay above the previous day's high now, which is at 42,250. So if and when we go back above,
yeah,
and take out the most recent high, which was at 42,800 ish. A move above that area would tip the balance in the bull's favor, I think, in the short-term outlook, which could then lead to a rise towards 46,000, or 45,700 area. This region here, which I'm about to paint on the chart, which was previously support. So that could be our first target on the long side if we climb above this area first. Sorry, Victor, were you saying something? I cut you off there.
Yeah, no problem. I just wanted to remark that we've been very negative on Bitcoin over the past few weeks, and this scenario is starting to, well, it's not starting, it's continuing to play out, and it doesn't look much better on the daily chart, to be honest. This brief showing below 40,000 coincides with the support level. That's true. However, note that Bitcoin has dropped down 42% from the highs. That's
huge.
We really if we don't see any buyers at these levels, things can get ugly really quick. So this is something for you to have in mind if you are into trading cryptocurrencies. These levels are quite important for the longer term price of Bitcoin. This is something that you should be paying close attention to if you have any cryptocurrencies, regardless of whether it's Bitcoin.
Indeed. I am certainly keeping an eye at this level because I think the recent dip has made it more likely that if and when we see a low, that we will see a nice reaction to the upside. So I'm actively actually looking at some of the cryptocurrencies here, some of the altcoins, I should say, for potential buying opportunity. But obviously, that's not trade or investment advice. That's my personal opinion. And there are quite a few interesting ones to look at, which we will cover in more detail, perhaps in another webinar. But I like Cardano and a few others that are that have the potential to become something in the future. Other cryptocurrency, famous or popular cryptocurrencies like Ethereum, still not showing any major reversal signs. But let's see what Bitcoin does, because Bitcoin is the dominant one. And Solana here testing the 200-day moving average is an interesting one to keep an eye on. Apart from that, this one, BNB, is above yesterday's high, testing the 200-day from below. It has done this in the past, break below the 200-day moving average briefly or for a few days before reclaiming it, like here. And this could be yet another example of that. So if it reclaims the 200-day moving average, I think it's going to be a positive technical development for this particular crypto. Any other cryptos, or indeed any other markets that we haven't covered, we can talk about those markets. If you guys that are live in this webinar, that have attended this webinar, please let us know in the next couple of minutes, because I think we've covered all the other markets, haven't we, Victor?
Pretty much, yes.
Yeah.
So now is the time if you want to ask us a question about a market that we haven't covered.
So for those of you who are watching a recording of this, I'm going to end the recording here. Thank you so much for joining us. For those of you who are live, who are here with us in this webinar, we'll wait for your questions if there are any for a couple of more minutes. But for those of you who are watching a recording of this, thank you so much for joining us live. Thank you so much for watching this webinar. If you liked it, please like and share. And if you want to join us live next time, go to our website, thinkmarkets.com, go to market analysis and click on live webinars. Here you will see a list of all the upcoming webinars that you can register for. Okay?
Yeah.
So see you guys soon.
See you soon. Stay safe out there. Bye-bye.